Hello and welcome to another M&A Healthcare Advisors Insights video. I am Andre Ulloa. I am a partner and executive advisor at M&A Healthcare Advisors. We are a consulting and advisory firm focused on sellers and sell-side engagements in lower middle market healthcare. We are representatives of clients who have healthcare businesses and looking to sell or looking to recapitalize their business in some way. Our focus is to provide the highest level and most sophisticated service to clients, and we do that through providing information and guidance that is in the market and the standard for operating an M&A process. In that regard, today we have a guest who is a CPA and also a longtime friend of the firm who has worked with healthcare clients of ours in the past to get them through a successful sale in their business. And without further ado, I'd like to introduce Doug Walters, a partner at Walters and Associates, a Florida-based CPA firm.
Sure. Thank you, Andre. I'm very excited to be here. We're a healthcare-focused CPA firm. I've been in the healthcare arena for close to 30 years. I'm almost afraid to admit it. Shows my age, but been around for a long time. We've got about 35 personnel that are working in the healthcare space, and we have a national client base. So I think what's a little bit unique about us, and we're a typical CPA firm where we do audit, accounting, tax, but I used to own and operate home health companies. And so I've been on both sides of the M&A table in the healthcare space, selling and buying my own entities, and as well as starting them from scratch. So that's given me a unique skill set, I think, that helps our clients today.
Yeah, that's great, Doug. And one of the things that is so valuable is how we put these financials together and what we present to the public. And in many respects, the CPA and also the CPA that thinks like a CFO and understands transactions, that's such an integral part of the process and making sure that we go out to market prepared, right? And putting the company in not necessarily the light that is the best light, but in the light that is the actual performance and where the business is. So no, it's great to have you here today because we have worked together on a number of transactions, and I wanted to start us off with some questions around where our roles are in all this. So with that, Doug, can you provide insights on why we need a CPA and an advisor in a transaction that, in particularly in a transaction in the lower middle market in healthcare?
Sure. Yeah, I think if you don't have those or that arsenal, you don't have those people on your side, I think you're leaving things on the table. The other side is going to have a CPA. The other side is going to have some advisory assistance. And so if you don't have someone in your court, I think you're missing the boat. We have typically, we've seen clients where they've got decent financial statements. They think they have. I'll give you an example. I had one not too long ago where, they had a loan payment where they were just paying the loan account on their QuickBooks file, and the loan account had a negative balance because they never set the original loan up and to begin with. And all the payments went to the loan account. Well, some of that is interest. I should have went to the P&L. And what happens there is it's an easy fix, but a CPA would have caught that, right? And once that goes to the other side, now you're in a situation where you may lose trust. The financial statements are garbage. All of a sudden, in the other party's mind, we can't rely on them. And so I think if you have a CPA from the beginning to look through things, to make sure things are accurate, to correct. We all make mistakes, right? But to correct those mistakes before the other side gets them, I think puts you in a much better light and a much better outcome.
It's so true. I mean, so much of what we talk about is trust. You probably hear it in every video and it's not just trust with the client and us as representatives, in that they can disclose, and we hope that they disclose everything about the business, but it's also that when we go out to market, first impressions matter.
Yeah.
And, the buyer doesn't want to see a perfect business. Honestly, they just want to see an accurate account of the business, and it all starts and flows through the financials. So, I mean, what do you do in that regard if a client comes to you and says, "Look, I've been running QuickBooks, and I've got." We hear this all the time. The accounting is great. My financials are great. All the pieces are there. I know that I'm generating this cash flow. How do you handle a client like that where they come to you and say, look, I just want to be prepared for what this transaction has in store, and can you please review these financials? I mean, does that scenario happen to you, and what do you do in that regard in terms of a response?
Sure. And I'll give the client some assurance and say, look, your financials may be in very good shape. They may not need any help at all from my perspective, but you want to be prepared on what questions are going to be asked. So let me take a look at them. Let me ask you the questions so you're prepared. And if nothing else, if we do see some issues, we can correct them.
Yeah. And do you find that in this market now that financials are still the keystone of, getting the deal done? Because we see a lot now in healthcare where there's other metrics, right? Other buyers come in. And how do you focus in on those potential metrics? So if there's a buyer that comes in and says, look, I'm interested in understanding, the utilization within the company. Do you incorporate those operational fundamentals into your analysis when you go back to the client? And can you do that?
Yeah, we've been in a lot of due diligence deals where we'll be on the side where, a buyer's looking at a company, kicking the tires and saying, okay, can you go in there and really let us know if this is a good deal or not? And so we'll look at referral sources. Certainly, if you have all of your referrals coming from one source, that's more risky than if you have them coming from multiple sources. So we'll look at all of that if we're doing a due diligence type engagement. So we'll look at basically ripping the hood off, right? That's what you want to do and find out where the skeletons are if they exist. But primarily, your financial statements are going to be the number one resource to determine what the price is ultimately going to be. It's going to be some multiple of those financial statements, and you've got to get it right.
Yeah, we come across quite a few transactions now where net working capital becomes a big part of the negotiation, and sellers feel very strongly that that's their money. And you and I have our perspectives on it, right? I mean, if a buyer can come in and pay a premium to buy the business, and part of that premium includes the working capital. So essentially, if their valuation is taking into account net working capital, then we can also frame that to the seller. But what kind of situations do you get into with net working capital, and how do you end up working that through with your clients?
Yeah, so I'm kind of going through that right now with a large client that closed 2 years ago. They're still working through the working capital calculation. Believe it or not, this is not typical. Usually, it's 60 to 90 days post close. You'll get a second working capital calculation, but it gets complicated, right? So we're having to look through all of the accounts payable to look at, what checks were paid, what was related to post close versus pre close. We're looking at the cash accounts. What was the beginning balance? What was the accounts receivable? There's a lot that goes into that, and so we're seeing all kinds of issues there. It gets complicated, and most people that I've seen, they get the transaction done, and the working capital is kind of an afterthought. Yeah, we're going to leave enough in there, and we'll settle later. But that always becomes a bone of contention. It's a lot of work, and it's basically a discount on the deal, in my opinion.
Yeah, and I'll tell you, with the straddle periods, and with the back and forths, and then the true ups at the end, there's a piece there that we really require someone coming in from the outside and giving us all the pieces of the process by which we're going to make sure that we get this working capital situation figured out, right? Because what the structure that you're talking about that tends to happen is that there'll be very rarely is there necessarily a surplus, but in some cases there's a deficit to what you agreed on in terms of working capital, but that calculation doesn't happen until a couple months down the road. And so, we have yet to be in a situation because we go into this so prepared, and you would obviously be in the same position where you would prepare your clients for this, but we haven't been in a situation where there's been any activity at the true up, right? The working capital is calculated. We spend a lot of time on it. And when we got to that 2-month period, usually it was, hey, we're all good here. Or maybe there were some marginal changes, but nothing material. So yeah, I mean, has that been your experience as you've gone through this? And do you think it's good now that we have this structure where back in the day, it tended to be a lot of, people waking up, a few days after the deal was closed going, hey, where's the money in the cash account, right?
Right. Yeah.
Or the receivables.
Yeah, and I think that goes back to your initial question: is why do you need a CPA involved from the beginning? And that's a prime example of getting it right, because no one likes surprises, especially post close. You bought the new farm, everybody's happy, and all of a sudden now you've got a huge payback, right? So we don't want to be in that situation. We don't like surprises, and I know our clients don't either.
Yeah. Usually I don't like buying the farm on my deals.
Right.
But yeah, it happens. Many deals die, unfortunately.
Yeah.
Which actually, it's interesting because we also like to set up our clients to understand what life is after the close. And that's another area where it's helpful to have a third party come in with your expertise and say, this is what the tax implications will look like. And then also to understand, okay, where does a sort of post-transactional income situation look like, right? And not that you're going to do that from a wealth management perspective, but you definitely can get the calculations down in terms of the federal implications, the state income implications, if there are any, other, transactional closing costs and all that. And putting all that in order is also, I think, an important thing, and an important service that you provide.
Absolutely. There's going to be a lot of provisions in any asset purchase agreement or stock purchase agreement that have tax implications, and they have to be reviewed by a CPA that understands what those provisions are. So just as simple as, what's the difference between a stock deal and an asset deal? A lot of buyers and sellers may not understand that. And so we go through that detail and kind of explain that to them and what the implications are, because there are some significant implications there.
Yeah. And definitely, we're in California, you're in Florida, you're much smarter than I am for doing that.
I wouldn't go that far.
I actually love paying taxes. It's
I hear that over there.
My pastime. Yeah. But there obviously are some mechanisms, for instance, that are state specific in California, and you're very current on those as well. I know that recently we had a transaction where there's a pass-through entity election tax. It is similar to the SALT tax that we had back in the day, and essentially it allows for a cap on the income tax in California, and then it allows for that to be deducted from the cap gains side of it. So I don't want to get ahead of my skis, but point is, you are very involved and you are knowledgeable about what's happening in other states outside of Florida as it relates to these tax implications.
We are, with a national client base, that requires us to be current in every state that we operate in, and we do operate in every state. So we've got some very expensive software that helps us with that, for sure.
Oh, that's good. Well, I'm sure it pays itself off.
It does.
And then in that regard too, just when you go working with these clients, your main focus, I mean, I know that your experience is heavy in healthcare, but would you say that your main focus is in healthcare clients?
It is.
Or yeah, I mean, is
Yeah,
that
I
right?
mean, we've I cut my teeth in healthcare, right? So the firm was founded on healthcare, and so we service clients from the what we affectionately call mom and pops across the country to large publicly traded entities. So we've got the full gamut there, and we've been doing that for over 25 years. We do have other entities as well, so as a full service firm on the audit side, we're auditing banks, for example, and we get into the non healthcare clients as well. But primarily my personal focus has been healthcare.
Okay. And just one more aspect of sort of the transaction and our piece in it. Uh, we have now every transaction involving a quality of earnings study, right? And for the listeners out there, this is essentially an analysis that's done by the buyer investor, and it's a heavy scrutiny of the financials and of other operational metrics, right? And one of the areas that it digs into might be the adjustments that we apply to EBITDA. And so when you're dealing with clients and they're going through a transaction, is that something that you work with constantly, is responding to the quality of earnings people on the other side of the table?
We sure do. Yep.
Yeah.
Yeah.
And what would you say, for us, our perspective on quality of earnings is there's sort of two responses. One is there's either we have a reduction here in what we expected based on, the fact that they don't accept the adjustments, or the adjustments will change under the new ownership, or that there's some particular line item that may have not been accounted for properly. A lot of times it happens with receivables and going from cash to accruals. So in all of that, in your experience, there's sort of that mode of like, hey, this number isn't quite what we wanted it to be. The other response is silence, right? Like,
Right.
like we don't hear anything from them, probably because we actually performed better. It hasn't happened very often, but we performed better than than they expected in their analysis. And
Sure.
so they don't want to come back and tell us, hey, actually, your company's worth more
That's
than
right.
we're paying for it. But would you say that, in your experience, that that it's essential to have somebody with a deep knowledge of the financials, a CPA type person involved in that whole dynamic?
Absolutely. Yeah, you want to give the right answers, right? You want to understand, what those adjustments mean, why they were made, and why the question is being asked, right? So there's really digging into the detail to get an answer that's accurate and makes sense, right? And so we do that all day long. Yeah.